this particular video, you're going to want to listen to the interview on YouTube on the Hagman report. I believe that's the Hagman and Hagman father and son duo. I was actually interviewed by them once or twice years ago on some stuff. Good guys, good father and son duo. Like those guys a lot. But they had, I think, the guy from SRS Rocco Report or whatever on their show to talk about something interesting, and this is right up my alley. So I'm going to read you what they have at srsroccoreport.com. But as usual, I put the link in the description box of this video, YouTube. I would urge you to click this link and go to this site because it links to another YouTube video plus the charts and things you can look at to see exactly what he's talking about. But it's a very interesting interview. And it has to do with the pension Ponzi retirement scheme. Not necessarily pension per se, just the retirements in general. But it's titled, Warning, U.S. Ponzi Retirement Market in Big Trouble. Protect with Precious Metals. And you guys know me. Oh, Jay Snev, here he goes again with his gold and silver stuff. Here's the thing. Sometimes I'll talk about these things and tell you, yes, you need to get precious metals. You need to get your gold. You get your silver. This will help you. But it seems like pretty recently, I should say. I'm about to say pretty lately. Pretty recently. The words are right there in the article. Protect yourself with metals. Buy gold now. They're putting it in the title themselves. And it's not like these, SRS Rocco reports trying to sell you gold. So they're putting it in there to scare you. No. It has thousands of years of history of protecting people's livelihood, financial livelihoods. And it will do the same when it is called upon to do so. And believe me, looking at the debt numbers, the GDP, the Ponzi schemes, the pension nonsense, completely underfunded by God knows how much, unbelievable amounts, only one thing will be left standing: precious metals. It says the U.S. retirement market is in big trouble as annual benefits paid out are no larger than total contributions. So let that first sentence sink in. The U.S. retirement market is in big trouble as annual benefits that are being paid out are now larger than total contributions coming in. Quick look surprised. Actually, the amount of net withdrawals were the highest in history. I wonder if this has to do with that old baby boomer thing I was talking about the other day, where a whole lot of people are going to be retiring, some of them now 70 and a half years old, forcefully having to get out of their market position by law and start taking some profit, if you will, or income. That's part of it, but that ain't the whole of it for sure. So actually, the amount of net withdrawals were the highest in history. When payouts become larger than contributions, then we have the making of a typical Ponzi scheme. I mean, think about it. Ponzi scheme is take investors' money and constantly needing new investors and showing these outrageously high returns. And then the original investors are, okay, it's time for me to collect now. Okay, and they take the profit from all the new people giving in and hand it to them to let them know everything's fine. We got the money. Like we said, it's a good investment. And then the next set of people who invested are asking for the same thing. And before you know it, too many people are asking for their returns that you've promised, and you keep showing them a chart every single week, every month of these awesome returns, and now they all want theirs back. But it's contingent on new blood coming in and giving us the investments. And when that slows down, or it stays the same, but the amount of people asking for the returns or needing to get their returns back increases, it's over. Ponzi scheme exposed. That's what the definition is. Americans who have invested their hard-earned money into a 401k had no idea that it was the greatest Ponzi scheme in history. Unfortunately, when the markets crack, so will the value of the U.S. retirement market. On the other hand, Americans who were wise enough to purchase physical precious metals will protect their wealth as the U.S. paper retirement market collapses. According to the most recent data by the ICI, which is the Investment Company Institute, the U.S. retirement market ballooned to a new record high of $25.3 trillion at the end of 2016. And they have a chart. You don't need to see this right now. As we can see, the U.S. retirement market has nearly doubled since the collapse of the housing and banking sectors in 2008? All this money printing, buying stocks, bonds, all this crap, the money was just flooding in there, creating this artificial bubble. And you have a 401k, don't you? Well, of course, it's going to benefit. It's great. It's great news. It's only great if you can retire and take it. And actually cash the whole damn thing out and take it. Oh, you have a job? Sorry. You're not in a financial hardship. You cannot take this out. But I'm willing to pay the 10%. I've got a very bad feeling about the market in the near future. I need my money. I want it now. You can't have it, sir. Are you in a financial hardship? No, I'm not. Well, actually, I am. My job doesn't pay that well. Oh, it doesn't? Oh, well, in your case. Oh, wait, you have a job, though. Yep, well, sorry. Need a worse hardship than just being a low-paid job. You don't qualify. Who is anybody to tell me when and where and how I can have something that's already mine? I've been putting money into this account, and all you people who control the 401ks, you know, Fidelity and all these other companies, I'm giving you my money, and you're taking an interest rate right off the top every month forever. And when you combine that with billions and billions of dollars, ultimately trillions, when you look at all of them, you're making a whole lot of money off of us. And it's my money I'm putting in there, and I want it out now. Sorry, sir, can't do it. It doesn't work that way. That's what you're going to find out. And there's going to be a lot of suicides. Like the Webbot says, it's going to happen again. And it was correct last time around about a bunch of suicides, banker suicides that were very highly suspicious. Because people are going to realize what they've done to other people. Not only that, people who lost everything, like Joe Salente says, have nothing else left to lose. They're going to want blood. Who did this to me? And most people will go directly to the company that handled the 401k or this group, not realizing, guys, you got the wrong people. Yeah, they have an issue, but it's above them. That's where your money went. Who is flooding the market with sell orders? Find that information out, and you'll find out who the culprit was, because you'll see that they were flooding their sell orders while everybody was buying. How did they know to get out while you all were still getting in and the 401ks were still pumping money into it? Those are the people you want to pay a visit to. Ask them, what did you do with my money? So, as we can see, the U.S. retirement market has nearly doubled since the collapse of the housing and banking sectors in 2008. Doubled? In 8 years? It doubled? Total value of U.S. retirement market increased from a low, again, during the worst part, $13.9 trillion to now, in 2008, to now $25.3 trillion as of end of 2016. It's not quite double, but you get it, close enough. Furthermore, the surge in U.S. retirement assets from $19.7 trillion in 2012 to $22.6 trillion in 2013 was due to the Federal Reserve quantitative easing 3 policy. This was the year that the monetary stimulus was funneled into the stock, bond, and real estate market and away from the precious metals. Thus, the precious metals suffered huge price declines in 2013. As Americans continue to contribute into their supposed retirement plans, few realize that more funds are now headed out than coming in. This is not a good sign at all. If we look at the most recent data from the Investment Company Institute, Americans contributed a total of $373.6 billion into their private sector DC plans in 2014 versus total benefits paid out of $402.3 billion, which means net contributions were a negative $28.7 billion. By the way, the highest on record ever. And they show a chart again. You don't really need to see this. This explains it plenty. The gray bar represents total contributions, while the red line shows total benefits paid. The net result is shown in green and red bars at the lower right of the chart. Green bars are positive net contributions, while the red bars are net withdrawals. Again, I've already told you what they are. You don't really need to see this. You can just listen, all right? Unfortunately, the Investment Company Institute does not provide data for 2015 or 2016 yet. It only goes to 2013 or 14. It will be interesting to see if these net withdrawals continue to increase, and my gut tells me that they most likely have. Note, the majority of the private sector DC plans were 401ks, which accounted for roughly 98% of total contributions and 91% of total benefits paid. So why is the U.S. retirement market in big trouble? Well, if we look at the next chart, we find our answer. And I'll go ahead and post this one. The chart shows that the U.S. retirement market has increased right along with the surge in total U.S. public debt. Thus, the U.S. retirement market's value is being propped up by debt. And what did I tell you 400 times now? It takes $4 of debt to create $1 positive GDP in this country. USA only, not the whole world. $4 of debt in this country to create $1 of GDP. Well, that's sustainable. We'll get past that. It's just not a trend. This is just a little speed bump. We'll get over it and it'll go back to less debt to create $1 positive in GDP. No. I'm sorry, my friends. It will not work that way because we have a central bank that demands when money is borrowed, there's interest attached to every single dollar, and they don't print the interest. They only print the principal, but you owe $1 and some change for that dollar you just borrowed. Government. How are you going to pay it? Well, we got to borrow more. Here's $2. Now you owe $2 and some change next month, etc., if you will. But I don't have the money because you only gave me the principal. Yet you're asking me for principal and interest. How do I give you the... You don't. And we will make sure you go into perpetual debt until your freaking society collapses on a debt burden of epic proportions. Thank you, central banking, fractional reserve lending. More specifically, though, it's the central bankers, Federal Reserve, the club. That's why. So, as the U.S. debt exploded from $875 billion in 1980 to $20 trillion currently, the U.S. retirement market. See, by the way, did I just not say that's exactly what happened? $875 billion in 1980, so less, just a hair under $1 trillion. To now, 30 years later, a little more than that now. 37 years later, if you will. 20 trillion from 1 trillion. Jay Snip, didn't you just say because we continue borrowing money with interest attached and we have to pay it back and not only pay it back, you got to make payments to the people, interest rate payments. It's like having that credit card that you never pay down, you just make the interest payments while simultaneously using more of the credit. And you never pay it down. Never pay it down. That's the way the central bank, the Federal Reserve, was designed. Have a nice day. So, the U.S. retirement market surged from $822 billion to $25.3 trillion. That was the U.S. retirement market. From then, 1980, $822 billion retirement market to $25.3 trillion in the same period. We must remember the following. Debt, this is key. Debt is not an asset. Well, duh, right? But think about it. Also, the true value is subtracting total debt from assets, right? I mean, you have to. You can't say, oh, I'm a big shot, I'm worth $5 million, but you only have $5 million in total assets, but you have $10 million in liabilities. And not just liabilities, let's just say pure debt. Then you're actually a negative millionaire by $5 million. But on paper, you can fudge it and make it look like, through accounting tricks and stuff, I'm a millionaire. And you have a millionaire's house, you have the millionaire's car, you have all these things until the day you got to deal with that debt. Then it's good night. Thus, if we applied simple math here, the U.S. retirement market's net value is approximately $5 trillion, 80% less than what it is currently. And that $5 trillion figure is likely inflated. I do realize I'm making a very general calculation here, but debts are not assets. I discussed this in my recent interview on the Hagman Report, which I highly recommend watching if you haven't already. The reason the U.S. retirement market is a huge Ponzi scheme is that it has stored digital IOUs rather than real physical wealth. A typical stock price is based on net present value. They take the future value of the company's earnings to give it a price today. Unfortunately, companies' earnings are based on the burning energy in the future. And there lies the rub. Back in the 1930s, most stock prices were based on the book value, basically what the value of the company was worth if all its assets were sold. Today, a stock price is based on earnings. Earnings can and will implode when the markets crack due to massive debt and falling oil production. However, the few Americans who were wise enough to purchase physical precious metals rather than put their money into the greatest Ponzi scheme in history will be able to protect wealth while most paper assets disintegrate. $100,000 physical gold investment versus $100,000 invested in 401k. If an American decided to purchase $100,000 in physical gold over the last 30 years, same time frame that they were showing, they would have a true physical asset that they could sell close to that $100,000 figure. If an American had $100,000 in their 401k, they would have to pay a 10% penalty for early withdrawal, while a 401k withdrawal is taxed as regular income compared to physical gold taxed at a maximum of 28% capital gains. At least you can hold on to nearly 3/4 of your wealth, likely much higher percentage. That being said, once the market crash occurs, the value of most Americans' retirement assets are going to implode. I would not be surprised to see at least 50 to 75% collapse or more in the typical U.S. retirement account. Thus, the $100K invested in a 401k would fall to a low of $25,000, while $100K invested in physical gold could easily double to $200,000. Actually, this is the likely outcome. Mark my words. A typical American who has invested $100,000 into a typical 401k will find that his or her retirement account will fall to 1/10 of its value versus someone who purchased physical gold instead. The coming collapse of the U.S. and global oil industries due to lower oil prices will be the factor that destroys the U.S. retirement Ponzi scheme. It is not a matter of if, it is a matter of when. Please continue to back the SRS Rocco Report, as I will be providing updates on the continued disintegration of the U.S. and global oil industry. Paying attention to what is taking place in the energy industry will provide clues to the timing of the market collapse. Now, I will also add this piece myself. Even if gold were to or oil were to jump back up 80, 90, 100, $110, $120 a barrel, I don't think that that's going to change any of this. You still have the debt issues. You still have the rest of the freaking economy. And all of the whole world, and especially the U.S., because most of us are U.S. citizens, and that's who mostly my subscribers are. They can have a fantastic oil rally. What happens to your pocketbook? On top of the high real estate prices, the high rent you're paying, the high everything, freaking new car, everything you're paying. And now you got to pay high gas again. Up $3.50 a gallon again. $4, where are we going? How's that going to work out? Is that good for the economy? No. Wasn't it interesting that also in 2008, that's when we saw $150 a barrel oil in July. Remember that? Lindsey Williams was out doing the interview saying, I told you it was going to 150. Here it is. And by the way, while it's at the peak, $146 a barrel, I just got word from my elite friend, which happened to be Ken Fromm, it's going down to 50 and below by the very beginning of next year. Lindsey, you are out of your freaking mind. It's not going to happen. And it did. But we had a stock market crash in September, October. I mean, that's when it started. We had Lehman go down and the banks that were in trouble, which caused the whole thing to go down. Or was that really the reason? How could he know in advance that the price of oil is going down? Because the price of oil went down with the markets. And it was made to look like, well, the whole stock market's going down. Oil went down with it. Except the stock markets have fully recovered and then some, but oil is still $50. So I'm here to tell you, if oil rises, sure, you could say, oh, all the hedge funds will flood into oil, stocks and stuff, and they'll make their people's, the retirement accounts out there do well. I don't think so, because the whole world doesn't just invest in oil. There's everything else out there. Oil is just a piece of the pie, right? You got to diversify. You're not just going all in oil. Anyways, I don't think that would matter one way or the other, whether oil goes up or down. So his point's still valid one way or the other. Take care. And again, I'm going to link this so you can check out the video. It's an interesting conversation. Take care.